So why is it that the physical product silver, or your physical silver that you can actually order off of websites like SD Bullion, JM, APMEX, eBay, and wherever else, why is it that the price on that silver is so much higher than what you are seeing on the stock market right now? That's what we're going to talk about in this video, guys. That there is a hashtag silver squeeze still brewing for the physical market, and I don't think it's going anywhere anytime soon. And we have proof of that just by looking at websites, again, like APMEX, SD, and JM Bullion, and seeing that they have order delays going on 7 to 10 days. You can also call around shops, local shops, and talk to them. And here, most of them tell you that they don't have a whole lot of physical silver in hand right now to sell. And if they were to order from their wholesalers, they have delays of a couple of weeks or more to get it at the wholesale prices where they can turn around and resell it to you. So why is that? Why is there such a huge disparity between the stock market silver, or the silver that is being traded right now in the stock market that is being manipulated by big banks, and the physical silver in your hand? That's what we're going to talk about in this video. But really quick, guys, before we get into it, don't forget to like and subscribe and click the bell so you don't miss my future video notifications. So let's go ahead and take a look at what the stock market silver price is doing right now. This is an actually updated, refreshed. In fact, I'll F5 it right now. This is an updated, refreshed, as I'm recording this, 1452, February 16th, 2021 spot bid silver market. You can see that over the last 3 days, and this has actually been over the course of the last couple of weeks, silver is held right into that $27 to $28 range. It actually jumped all the way up to $30.30 at the beginning of the silver squeeze on the speculation of the Sunday before. In fact, I released videos on it where APMEX, SD Bullion, and all them actually pulled their silver off of their site until the markets opened up because they were worried that silver was going to jump so high that they would not be able to replace the orders that they were filling and taking in right then and there. So they waited for these markets to open up before they even started taking orders again. And of course, those places actually opened up their markets almost immediately as the spot market opened up that day. But it jumped right up to 30 and then very quickly back down, almost like a reverse V, just up and down. And it went right back into that $27, $28 range. And that's where it's been hanging out for the last couple of weeks. You can see that this morning we actually had a pretty big drop and it jumped right back up because there really is a demand. And there's a lot of people that are going to have to take delivery on these COMEX orders that they have in to fill the physical demand. There's a huge physical demand for silver right now. We all know it's there. They all know it's there. JM Bullion and SD and APMEX and all the other online retailers know that it's there. Physical shops know that it's there. We did a couple of calls last week where we called and spoke to and interviewed a couple of local coin shops. They know it's there. They're talking about weeks and weeks upon delivery for wholesale silver so they can turn around and sell it to people across the counter. The silver, the physical silver, the high demand has not went away, even though everyone is trying to play off that the silver squeeze really isn't a thing that happened. And on the paper market, it really definitely did not. There was an attempt to bump it up. It did not happen. People bought into the speculation on the paper market and it dropped right back down. I'm sure some people lost money on that, and that's really a risk when you do short-term silver investing. It's just how it is. Of course, myself, I'm not a short-term investor. I'm a long investor in silver. I have always been a long investor in silver, and I'll continue to be a long investor. I think there's a lot of risk into trying to play the silver market, especially right now, to make money on the short term. Unless you're a huge bank like JM, or I'm sorry, I didn't mean to say JM Bullion. My apologies. But unless you're a huge bank like JP Morgan, which is what I was trying to say, there's really no money for you to be made, and it's very risky. I mean, it could happen. I'm not saying it can't happen, but it's very, very risky with how volatile the silver market is right now. But that volatility is not there in physical. Let's take a look at some of these sites and you'll see what I'm talking about. Take a look at JM Bullion. They literally have in red bold right here on their website saying, due to extreme order volumes, please expect shipping delays of 5 to 10 business days. We also have a temporary $299 order minimum. In other words, small orders are not going to be accepted right now. If we go ahead and go into their silver, we'll take a look at their in stock, we'll look at silver rounds. So we'll get as low as we can. We have these at 32.28. Now keep in mind the 32.28 is if you buy, in their case, 500 ounces at once. If you were just buying 1-19, well, of course, to meet that $300 minimum order, you'd have to buy around 10. But my point is that you actually get it for 33.18, and that's if you don't pay PayPal or credit card. At that point, you're paying 34.56, and that's just because PayPal and credit card companies do charge a fees to these companies to to process those transactions. They do take crypto, which is a little bit cheaper, but again, there's also a fee for crypto as well. But my point being is that, the premiums are way up. So 27.39 to 33.18, where does that put us? That puts us at around what? 575 over spot or so with JM Bullion for 1 ounce. 575 over spot. You used to be able to buy this all day at a coin shop for $1.25, $1.50. Now 575. Let's take a look at SD Bullion. We got the same message. Due to unprecedented demand, we are currently experiencing shipping delays of 10 plus business days after the payment clears. And they do put after the payment clears on purpose because, of course, they don't want to set aside 1,000 ounces of silver for somebody whose check bounces. So that delay starts the day that your payment actually clears. And the same thing, if we go down and we look at silver, we'll go down and we'll find silver rounds right here, 1 ounce silver rounds. And we have 32.01 as low as for 1 ounce generics. Of course, it's 33.04 if you buy 1-19, which puts us at about $5.49 over spot on SD Bullion, $5.49 for generic rounds. Let's take a look at APMEX. Same thing. Look at Buffalo rounds. The same thing. Shipping delay, unprecedented demand, shipping delay. And 33.39, which puts what's that? That's that's $5.79 or 89 cents over spot, and that is with 6% off the premium. So of course, APMEX, as is the norm, is always the highest of most of the online dealers, unless you catch their deals, because they do sometimes have really good deals, which puts them the cheapest. And I've caught quite a few of those over the years. But again, that is what you are looking at right now. Physical demand is insane. So don't worry about, the fact that the silver market is in the 27s right now. The physical demand is driving the price. And actually, let me read you this quote. This came right off of Wall Street, not Wall Street Bets, but the Wall Street Silver, I believe, is the Reddit forum this came off of. And ironically, this came from a user, SilverSeeker123. So I like the guy's name. Let's check this out. All right, so really quick before I read this to you guys, keep in mind, I don't know where he got this. I don't know if he wrote this himself or if it came off of a website, or I don't know what his background is. But listen to what he says, because it really does make a whole lot of sense. Take a look at this. He says, the process is playing out. Record physical demand has emptied the supply chain. Dealers and mints are all making new commitments to deliver physical metal through the supply chain at an agreed price and are opening new long COMEX contracts. They, parentheses, hedge this new commitment on the futures exchange by opening a corresponding short sale position, which they will hold open until their metal is delivered off the exchange, and they buy the short contract back to close the short. This has a massive tsunami effect because while the short-term price is neutral, their long-term physical contract is the metal which they plan to take delivery on the COMEX because it must be secured to supply their downstream customer orders. They're hedged until delivery and are price neutral for the length of the contract, but they must stand for delivery, else they have no metal to supply their foundry or mint. The bullion banks know this and are likely panicking for metal. At the same time, other participants, he puts in parentheses, gamblers, whom don't want COMEX delivery and have no downstream metal forward sold, are trading contracts anticipating higher prices based on the fundamental demand spike. The bullion banks are pounding these positions via huge paper contract price volatility, hoping to shake these participants out at a loss. If they can smash price and cause margin calls, these weak gamblers get flushed, allowing the bankers to cover their smash attack at a lower price. And then he says, this has been the silver market for 40 years. This ends when these gamblers suddenly decide that they won't play on margin and for paper, and as a flood of buyers of the COMEX futures must stand and take the metal, and cannot be flushed because they are hedged. Now, what if the new bank shorts can't be covered as the gamblers stand and won't roll into contract or surrender? Just the commercial contract volume alone may completely overwhelm the physical available. But what about this additional gambler? And then he says, every ounce we buy today is demand for delivery. So the mints must continue opening long contracts if they plan to take, and a short contract to cover or hedge their price exposure until the contract delivers. If you're a large mint with $50 million an ounce capacity a month, and you have 150 million ounces of orders, you may be opening April contracts already, which you must take in order to satisfy the order flow. And that is very well said, Mr. Silver Seeker 123 over on Wall Street Silver. So guys, my point is that although obviously there's a lot of manipulation in the paper market right now, the physical market is strong, it's healthy, and there's a lot of people getting into it. And I think if you were getting into silver to hold long term, it's a very, very good idea. Now, of course, as I say this, remember, guys, I'm just another guy on the other side of the computer. So everything I say, take it at face value, and obviously get your own professional opinions before you invest any money, because of course, I may not know what the heck I'm talking about. So keep that in mind. I am not a financial advisor, and do not take my advice to heart. Go do your own research. All right, guys. Well, there you go. Thank you so much for watching the video. I hope that you enjoyed it. If you did, do me a favor. Don't forget to like and subscribe, because that really does help the channel out, and we will see you next time. Hey guys, thank you so much for watching. I hope you enjoyed the video. I did leave a video above. You can check out if you haven't seen it yet. I also want to give a huge shout out and a huge thank you to my awesome channel supporters scrolling right there on the right hand of the screen. Thank you so much for watching, and we will see you in the next one.